What's everybody missing?
Yeah, it's been quite the turnaround from where we started the year, that's for sure. I think what's happened here is simply the chase is on. So the equity market obviously is surprised to the upside this year. That coupled with the fact that the bottom hasn't fallen out of the economy just yet seems to be leading many economists to dramatically reduce their recession odds for the year. But I think that's a bit of a dangerous game here simply because equity markets can run right into a business cycle peak. And in fact, we've had a few recessions where equity markets have actually peaked after the cycle peak. So if we're hanging our hat on the fact that we've had this explosive rally this year in strength and coincident and lagging indicators, I think that's highly problematic, in my opinion.
But the leading indicators have been so bad that I'm starting to wonder if the storm's just going to blow over. In other words, looking at the literal index of leading indicators, I think it's never been down more than 12 months, which I think we're down 14 months now, maybe year on year. It's never, by month 12, we're always in a recession. So something very unprecedented is happening here where all the leading indicators have been so bad, but the recession hasn't showed up yet.
Yeah, yet. That's, I think, the key word. So the index of leading economic indicators, this peaked 18 months ago. The consensus is another fall for this past month. And so, it is getting, towards the longer end of the range. It's 18 to, I think, 20 months have been the longest lag before a recession hit. If we look at the yield curve, we've got an unprecedented inversion here, and it's deep and it's been very persistent. The 10-year to 1-year Treasury spread, which is the one that we focus on, we're 12 months into an inversion now. So typically recessions have occurred 12 to 14 months post-inversion, but sometimes it's 18. We've even had a few that are closer to 2 years. So to declare the coast clear, because payroll growth has been positive this year and the equity market has rallied, I think that's a bit of a straw man argument. And, with the Treasury yield curve, we're definitely getting there in terms of when we could start to see some serious trouble for the cycle. Let's see what the second half brings. If we make it through the first half of next year, then I think you're legitimately getting into territory where we can say, okay, the longest leading indicator, something has gone wrong here. But I think to be highly confident of a soft landing, simply because the equity market has rallied, payroll growth has been positive so far with this historic yield curve inversion, a historic collapse in money growth, historic tightening of lending standards. And let's not forget, the Fed's reaction function here is to get to a restrictive stance and then hold there in any configuration of the balance sheet that leads to below trend growth. So the no land actually doesn't make sense just based on what the Fed is seeking to do. They'll simply continue to tighten policy until growth weakens sufficiently. And as long as the labor market's tight, they are not going to be super confident that inflation will continue to roll over. Right or wrong, that's the reaction function.
Yeah.
And so with the equity market up here at a 20 forward multiple, we've got the Infotech index. It's led the rally this year at over a 28 forward multiple. We haven't seen that since the end of 2021, just before a more than 30% collapse in that index. So I think if we're upping the bullish bets here based on this action, and it's happened on no earnings growth, there's no increase in forward estimates from where we were last October, a dangerous place to be.
But I admire your conviction because, there's people, and I think sort of to put it less eloquently than maybe Goldman did, it's almost like they can't find a way to get to a recession at this point. We look at some of the consumer metrics, we look at housing, which has been kind of on the upswing, at least residential construction. You look at the fiscal impulse, which is getting more and more attention because so many of these fiscal projects have to happen before the end of 2024. And that seems to be kind of feeding in the construction boom that we're seeing, the investment, the infrastructure. So how do we kind of tip this economy over enough that within a quarter or two, and it looked like with claims going up a month or so ago that was starting to happen, and then they came down again.
Yeah, well, things could turn quickly. This so-called excess savings will essentially run out by the fall of this year. And so that could start to change the picture a bit. If you look at same-store sales and nominal aggregate, I mean, they're comping negative in nominal terms now year over year, and that data takes us into July. People seem to get excited over this retail sales report yesterday, but in real terms, inflation adjusted, you've got year-over-year growth down 5 months in a row, unprecedented outside of a recession. The jobless claims numbers have been volatile and have pulled back recently, but year over year, continuing claims are still up close to 30%. Again, unprecedented outside of a recession or just prior to one. So I don't think we're quite out of the woods here, but the equity market rally is simply coloring the perception that the soft landing is in the bag, and we'll see how that works out.